Hey, everybody, welcome. I see folks still making their way into the room. All right, great to have you here. Oh, I've got an echo. Okay, how come I hear myself? All right, there we go. Okay, gang, so welcome. I still have my echo. There we go. All right. Hey there, Ekon Gypsy. Hey there, Kifilwi. Sorry if I mispronounced your name. I'm a Raghee. I completely sympathize. Thank you, everyone, for making it out. We've got a short period of time here together, so let's just jump right on into it. Why are we here? Really succinctly, we're here because at the beginning of every week, it is really important in this dizzying market. How many of you feel like you're just getting spit out of the spin cycle on the washing machine, right? You start off Monday and you're still kind of feeling dizzy from whatever transpired the week before, right? I'm here with you. This is a difficult market, but there are ways to make this easier to focus on the places that we have more opportunity. How many of you do homework, on the weekends? I know if you're anything like me, you can't get enough of the market. This is the best game in town. And if you're like me, I used to get depressed on Saturday mornings. I felt like a dragon slayer with no dragons. And I started taking that energy and I started spending some time on the weekends, just maybe an hour or two, and asking myself, not necessarily what happened the week before, but what is it that I am going to deal with in this coming week? So I'm not distracted by whatever it is television wants me to worry about. I'm not distracted by whatever the big mover is this week, but I'm focused on the places where I can manage risk and find opportunity. That's what homework is about. That's how we find clarity in this environment. And ultimately, that is what we're going to talk about here today. I'm going to walk you through the process that I use every week. So let's get to it, shall we? Great to have you all here. Excellent. If you have any questions, by the way, as we're going along, I can see the chat window, a lot of familiar names. Awesome. So I'm going to move myself down here into the corner. There we go. No one puts baby in a corner. That's okay. We're going to go ahead and take a look at some charts. We're going to take a look at some analysis. And I want to make sure that you all can see. I'm going to move this over just a little bit because I can see what you all are seeing. And I want to make sure it's big enough. What we have on the right is the Trading View charts. So many of you are probably already familiar with Trading View. If not, I'm going to use Trading View for much of our discussion here today. Okay. We'll focus on some daily time frames because when we are doing homework, let's start at the most obvious. When we're looking to point ourselves in the right direction, it's a slightly longer term time frame, even if we're day traders, by the way, that we want to start to understand. So I'll start with the daily for the most part. The idea is this. How do we know it's moving the market day in and day out? Believe it or not, it's not that many things. So if you want to write this down, write these three things down. I have this on a sticky note. I've had it for many, many years. Inflation, jobs, growth. So whenever we're doing any kind of analysis, and I don't mean getting knee deep in navel gazing macroeconomics, but what are the things that the Federal Reserve is taking a look at? It's those three things. When I start my homework off, and what you're looking at on the left is my homework. These are my notes, right? And I like to remind myself at the very top, this is one of my favorite quotes. If you only read the books, and that could be articles and blogs and whatever else, if you only read the books that everyone else is reading, you could only think what everyone else is thinking. Having an edge in the market is seeing the things that most people are either ignoring, they're being distracted by, or they don't know how to look at, right? Okay, we're going to fix that right now. When we are starting off the week, everything's about the FOMC. Everything, gang. It's the only macroeconomic factor, frankly, that matters. Everything else, when I mentioned before, inflation, jobs, and growth, that's what the Federal Reserve is looking at. That's why we're going to look at it too, right? Okay, so every week, ask yourself, what's the story that's overarching the market? Right now, it's probably earnings. We're in the trickiest part of the earnings season right now. We're in that few weeks between the release of the financials going into the heart of those tech earnings. And we know that that's going to influence the market. What else do we know? we just finished rolling over from Q1 to Q2. So I guess the first question I'm going to ask folks is, when we were rolling over from Q1 to Q2, and while the regional bank crisis, which doesn't seem all that far away, was kind of wrapping up, you can see here at the end of March, March 24 to be exact, we were already pointed in that direction, realizing that the story of the week, the psychology that was going to be moving the market, was still focused on that regional bank crisis. And you might say, Rog, I know that, right? I mean, news, that's all news could talk about. But the really important part is not engaging in that regional bank crisis trade. This is KRE, gang, right? All anyone could talk about are regional banks. What we did at the very end of March, so mind you, that was only 2 weeks after all the melee and the new crisis that was going to collapse the market. Remember, we were all circling the drain. The richest traders I've ever met, and what I've tried to, well, the folks who have mentored me, and what I try to impart on people that I am mentoring is optimists do well, gang. So what we try to do is, where is the opportunity, right? Not looking at the train wreck that is KRE, where is the opportunity? So rather than focusing on KRE, we already said 2 weeks later, when everyone was still thinking the banking crisis is just beginning, we said, you know what? It's time to start looking long financials, right? So how many of you are looking long financials? And show of hands that I can't see. How many folks were looking long financials back on the week of March 24, on that Friday? That's exactly what we were looking at. So that right here, this vertical line, let's make it a little bit bigger and brighter, shall we? That's what we started focusing on. Let the regional bank crisis happen, but we knew big banks, JP Morgan, Bank of America, Citi, Wells, they were mostly in a different environment. Why would we look at XLF? Because XLF is where the big banks reside, right? So on the 24th, we started thinking now it's the time to get bullish, but that's not all, right? Pointing ourselves in the right direction is not buying into the story that financial media wants us to freak out about. Then we take it to the next logical step. How many folks here, and again, feel free to type in questions if you'd like, okay? How many folks know the impact financials have on the S&P and the Dow? I know tech feels like it rules everything, right? But how many folks realize that the number one, and this is maybe something if you want to write this down too, financials, the XLF, is the number one weighted sector in the Dow Industrial Average. It's not transports, it's not industrials, it's financials. The number two weighted sector in the S&P is financials. So let me ask you, let's jump on over to the SPY. If I'm starting to find clarity in the financial narrative, the narrative that's just dragging the broader averages lower, but there's hope in financials, there's hope in that corner, what do we start to focus on? Well, we knew that the S&P was in a neutral sideways trend, but at that point we said, wait a minute, we've got some interesting oversold signals. In other words, while everyone else is panicking and buying into what's happening in the broader financial media, which, by the way, their job is to freak you out. Who doesn't know that, right? That's their job. Keep you freaked out, keep you tuned in, run ads by you, right? We started saying it's time to start looking at an oversold S&P, right? So that was back on March 24. That was a month ago, right? But some of these bigger picture ideas are still playing out today, right? So a month ago, this is where we were thinking we need to find opportunity, right? Not just in XLF, but then the bullish influence that that XLF would have on the Dow. Let's take a look at the DIA and the S&P, right? These are the kind of things that I start looking at and then start looking for data to support that idea, right? It's not enough to say, I think this is going to happen. Now we need to find the evidence. And that's what I will continue to look at. Another thing that we liked was crude oil, all right? So again, we're still back at the end of, you can remember, we're still way back at the end of March, right? And I said, it's time to start getting bullish crude oil because another big picture narrative. How many folks watch what OPEC is saying and doing? It's important. It's akin to watching what the FOMC is saying and doing, right? So let's drop another vertical line. What we started doing is aligning ourselves with a narrative back here. March 24, that if OPEC is going to continue to stick with the production cuts and the compliance is high, there's opportunity long in that market. So that's going to bode well for energy stocks, XLE. That's going to bode well for crude. Does everyone see where we're going? We're starting to put all these pieces together. And then once we have a narrative, we go to the chart with that narrative, right? And we say, all right, is this what's actually playing out? Okay, so let's take another idea here. And by the way, another thing that I like to do is dive a little bit deeper into why certain markets are moving the way they're moving. Let me take you all to another issue here. Let's go back to the updates. And by the way, I'm in the This Week in the Market section of the Simpler Trading website. Okay, so if you're on the dashboard and you scroll on down, there's This Week in the Market. So I started off with the very first issue of our reboot, and I took us over to that March 24. Let's fast forward to March 31, right? Little trip down memory lane, but these are the stories that cumulatively, like a soap opera, you keep putting these pieces together, you get more and more layers of understanding. So as we moved on into the very end of March, now we're talking about what? The quarterly, right? That rotation that we oftentimes see when money managers and funds and everyone they have a brand new quarter ahead of them. Think of it like a blank page. Think of it as getting to start all over again. Now they won't be graded by the folks they're managing money for another quarter, right? So that's the narrative. That's the psychology. And as we went into March, that was that dominating psychology. So we still went back and talked about KRE and XLF because that was still a very fresh narrative. But then we asked ourselves, if we're going to continue to move higher in the likes of XLF, or if we're going to see some opportunistic buying. Now, mind you, this is now March 31. And I think it's really important to put some reference as to where we are when we're having these conversations, right? So March 31, that's the issue we're looking at right now. As we end the quarter, something very interesting tends to happen. And I call it the Ferris Wheel, right? Those are things that I'll put into my homework. What is the Ferris Wheel? What are the things at the very top of the Ferris Wheel? The things that are enjoying the great view and the ride to the top. What are those things? I don't want to buy those things near the top. In fact, that is not what most money managers will do as we roll from quarter to quarter or year to year. We'll factor that into our analysis. So what then I remembered is fresh quarter, fresh opportunity. What's at the bottom of the Ferris wheel, right? What's at the bottom, and what is it that when folks are bargain hunting and we know that we might have a Fed pivot, we'll get to that. I'll show you how we also measure that. If I'm getting into a Fed pivot narrative, how do I know it's time to start being a little bullish? Well, so we kicked off that issue, right, at the very end of March, in the very end of the quarter, with reminding ourselves that there's a lot of data to suggest, whether that be Fed fund futures, whether that be inflation, whether that be the data that the Federal Reserve is dealing with and looking at right now, that we are at the tail end of the tightening cycle. What does tightening cycle mean? The cycle of rate hikes that we have been undergoing now for quite some time. We're almost at the end of that, which means we're reaching what's known as the terminal rate. What does that mean? The peak rate that the Federal Reserve are going to hike to. We're getting very close to that. In fact, as we talk today at the end of April, we're maybe one more hike into the end of this tightening cycle. In other words, one more hike, and it's very likely, the probabilities are we're going to hold. Well, if we're going to stop hiking, isn't that inherently a little bit more bullish? So when the quarter rolls over, we started focusing on at the very end of March, again, March 31, where are recession fears? I start showing you graphs, data right from the Federal Reserve. I say, hey, this is how to read this data. This is what it's communicating. And it started to indicate it's time to get bullish, right? And that's what we started to align ourselves to. So then here, I'm going to scroll on down to, and we use some seasonal charts. There's a lot of things, but I'm going to keep it to this conversation about quarterly rolling. And we started looking at, here you go. What are the target rate probabilities? Where are we likely to go, right? Come May, come June, come July. We follow those very, very closely. And again, after doing that research, after doing that homework, we realized the VIX is pretty low. Doesn't mean that it's going to stay there, but that's fairly bullish. And the Federal Reserve is just about done hiking. That's pretty good, right? And then we're starting to get a little bit of interest in commodity currencies. So a lot of this homework are things that maybe you do know how to do. Maybe you don't know how to do it, but my job is to point us in the right direction, right? So things that maybe you've never thought to connect those what seem to be disconnected dots, but in reality, they're there, right? So we started seeing a little bit more interest in commodity dollars. That's usually kind of bullish. We started seeing yen weakness. That's kind of bearish. Well, look at currencies, by the way. I've been a Forex trader for over 20 years. I'll tell you this much. Currencies are the biggest market in the world. And when you watch the cues from the biggest market in the world, it's going to start to filter into what we're hearing from the central banks, as well as stocks and commodities, right? Okay, so this end of quarter was pretty interesting. We started pointing in the direction of what? Staples, right? I started pointing at staples, and it's time to get looking at things like healthcare, right? And I'll show you things like these relative outperformance of the individual sectors. How many of you are familiar with the process of, and again, if you have any questions or comments, feel free to type them in. How's everyone doing so far? Is this starting to gel and make a little sense? Oh, Rog, I never thought to connect those dots before. Oh, hey, Rog, I didn't know that you were sharing your homework with us. So how many of you think, oh, okay, this could be really useful? All right. So if we know that we have possibly an accommodative Fed around the corner, we're Q2, we're turning the page. Now we ask ourselves, where can we get optimistic? And healthcare was definitely one of those sectors that was most, well, it was poised in the best way, most interesting way to benefit from some movement higher. All right, so there we started getting that alignment. So we're already bullish financials. That happened the week before. The next week, March 31, we start getting bullish healthcare. End of quarter brings a lot of clarity to the idea of sector rotation, meaning I'm not necessarily interested in buying things that are at the top. Maybe it's time to start looking for what sectors are going to look appealing to those folks and flow. Now, speaking of flows, all right, what does that mean? It's another thing that I research on the weekend. So I have this whole list of things that I'm looking at. Sectors, I'm looking at the Federal Reserve, I'm looking at the data the Federal Reserve shares, I'm looking at the data that we're getting in that might color the way the Federal Reserve shares their information, their messaging with us, right? The next thing we start looking at are flows, because flows, that's the evidence. Yes, price is very important. Volume, very important, right? But flows tell us a lot about what's happening with people and what they're doing with their money. And flows told us, as we started getting into some flows conversation, I think this was the one we might have started bringing up flows. There we go. One of the things I pointed out as we started April, so this is April 10, right? Again, sticking with this in a very chronological and way that maps to what we said and what happened. Come April 10, look at healthcare, look at financials, look at staples, but be wary of tech. Not that we can't buy it, but around April 10, we said, look, we're probably going to see some chop, if not some weakness, right? How do we know that? I'm not here to tell stories about what could happen, gang. When we do research, we have to look at the data. We find a story. And let me tell you, if you're thinking, how many of you find this really interesting? To me, I love this. I feel like a treasure hunter, right? That's what I feel like. It reminds me of I used to work on a dive boat way back when. Some of you might know that's when I first got introduced to a bond trader. And I really got the trading bug really bit me because I was already trading a little bit because of my mother, but I met an honest to goodness bond trader. He would rent out our whole boat, which it was not inexpensive to do. He rented out the whole boat and he wanted a private dive. So I was the dive master. My captain and I would take him on dives and he had the boat to himself. He just wanted the ocean to himself. And he would talk to me about trading. And I'm thinking to myself, wow, I'm already doing a little bit of this. And he must have seen my interest. And he started talking to me more about what it is to be a trader. Not to mention, he had really nice dive equipment and he drove a Porsche. Now, when you're that age, mind you, I was in college, that stuff impresses a lot upon you. And he talked a lot about data, right? You find a story, you find a narrative, and then you say, but does the data, that could be volume, that could be volatility, of course, it's price action. And here we're talking about flows. As we wrapped up the quarter, look at the down flows in the Qs. And even after the quarter, very lackluster between the technical, the volume, and the flows. I said, you know what? Look at that white line. At that point, we said the Qs may not be flying higher like they once were. We're going to see money flowing elsewhere. If they're not flowing here, remember, dollars don't end up under the mattress. They're not going into piggy banks. They're going to find somewhere else. That's my job, right? That's our job. Where is the interest? Therefore, the money going next. So it's another thing we dove into on April 10 and said, you know what? There's a lot of cool places in the market. Tech may not be one of them. It'll be well supported, but it may not be the one making consistently higher highs. We punched up and tested the April 4 high. We have yet to take that out, gang. So tech is definitely supported, but it's not the sort of sexy part of the market right now. And flows back on April 10 were giving us that clue. So do you love how now I know where to look and where not to look? I'm looking at staples. I'm looking at the rotation. I'm looking at XLF. We're looking at these corners of the market for those opportunities. Now, mind you, gang, this is not about day trading per se, right? This is about making sure that we're not getting sucked up into the narrative that television or whatever else wants us sucked up into, and that we're thinking about where we should put our interest, our attention, and finding where we should not, right? Sometimes what you don't do is just as important. So this is a little bit of a don't do, right? And we started talking about that on April 10. You know, the whole time, and I haven't talked about gold, right? We have been steadily talking about gold in the newsletter for some time. The buy the dip is alive and well. And this is where a little bit of the technical analysis pops in. And I started introducing concepts like an anchored volume weighted average price. I started introducing concepts like a slow stochastic, really basic indicators. And then I also started talking about volatility. And we started telling ourselves, you know what? It's time to stick with long gold opportunities. Now, long gold is an opportunity that comes when, and here's a little gobbledygook. It's some techno babble here, but it's really important. So you might want to write this down too. Real yields or real interest rates, another thing that we track. In fact, those are charts that I share here in my homework, in my weekly homework. When real yields are moving lower, meaning the nominal yield of a bond, what's the percentage? What is it yielding? Minus the rate of inflation, where that chasm is narrowing, bonds have the green light to go up. And that's exactly what we're seeing. Generally speaking, the bond yield has mostly been moving lower or steady, and inflation has been steady too. So that chasm is narrowing, and that gives gold the green light to move higher, right? And so we've been focusing on only the long side of gold. Sure, there might be some shorts and there might be opportunities to day trade or short-term swing trade gold to the downside, but I'm looking at the bigger picture. Long gold is where I want to be. Long from levels of support. And this is something that we continued to talk about, but April 10, we spent quite a bit of time talking about the VWAP and the gold. Now, gold can be gold futures, the GLD ETF, as well as looking at the miners, right? If I've got clarity in the underlying commodity, we talk about a number of commodities. Every weekend, I'll sit down and look at commodities. Gang, what moves the market? Treasuries, currencies, commodities. That's going to filter down to individual stocks. It's going to filter down to even some of the sectors. So now I know if I've got clarity on gold, right? If I've got clarity on gold, it's time to start also looking for opportunities in miners. Not first and not more aggressively than gold, but that means we can at least start thinking about it, right? So again, what are we putting on the radar? What are we focusing on? And what are we not focusing on, right? That's what homework should be. It should be a process of not just what to look at, but what not to look at. And here's a really common error that a lot of traders make. And maybe some of you, I know I used to make it. One of the common errors in trading is looking to make your watch list massive, as if a huge watch list gives us an edge. Gang, it's actually smaller. When you're done with your homework, when I'm done with this analysis, my opportunities are very, very specific. I've taken a big sea of stocks and commodities and treasuries and currencies and sectors and everything, and I've narrowed it down to where it is I want to look. If your homework, here's a really good litmus test. If your homework is leaving you with more to look at, go back to the drawing board and filter out. Filter out. That's going to make a huge, huge difference. All right. So back to currencies. One of the things that we've been also discussing, and these are still valid, gang. These are still very valid, is stick with the long dollar, gang. Stick with the long dollar. Why? I spent quite a bit of time explaining why the euro currency, not the euro dollar, the euro currency is why we want to stay bearish the dollar. The European Central Bank, let's talk about macro for a moment. The European Central Bank is still hiking, and they're nowhere near done. So they're a more hawkish, favoring higher rates central bank as compared to the US Central Bank. The most hawkish central banks are also going to have strength in their currency. A hawkish central bank, a central bank that favors higher rates, is in turn going to strengthen the currency of that country. In other words, a strong hawkish ECB means a strong euro. If the US is at the tail end of their tightening cycle or their hawkish cycle, right? That means the dollar is going to start to weaken. Why are we still bullish the euro and bearish dollars? Because of that fact, right? This is homework. So rather than thinking, oh, the dollar's going to rally, this way I know exclusively get long euro, get short dollar. How? Wait for volatility ranges, wait for retracements, right? The strategy, right? The strategy, which is what a lot of us are doing in the rooms, right? When we're getting into the nitty-gritty strategy, the homework's already done. We already know where we're looking for opportunity. Long euro, short dollar. There's no confusion. Now we know going into our charts what type of setup we're looking for. When people ask me, and I get this, my two favorite compliments are, Rog, you're really patient and you're really calm. It's because of the homework. I already know what I want to do, and I already know why I want to do it, because the data tells me so, right? Not some emotional gut feeling. My lower intestines aren't what make my trading decisions. It's the data. We stick with the data, we play the probabilities out. Things like long XLF and long XLV and long euro make sense because they're rooted in the logic of where the path of least resistance is. So when I get a move to the downside, I don't freak out because we're not buying at highs. We're waiting for pullbacks, right? So anyway, so that's another look at, again, how we continue to build our game plan. Where are we looking? By the way, I got into a little bit of the data behind recession. Frankly, why I'm not worried. And you might say, Rog, you're not worried about recession? Gang, what we worry about as humans with jobs and families, that's very different than what the equity markets worry about. The equity markets worry about what the Federal Reserve is going to do or say. Can it be reduced to just that? Look, the GOAT of trading, one of the reasons I dive as much as I do into the data and I dive as much as I do into the macroeconomics is based on Stan Druckenmiller. I'm a huge fan. One day I need to have an issue dedicated to his words. The only macro that matters is the Federal Reserve, and he's right. So therefore, the only data points that matter are the data points they're looking at to justify what they're going to do and what they're going to say. That's how simple it can be once we understand where the game is being played, right? Okay, so let's move on over to, well, where we are right now. Okay, so that was April 10. Stick with long gold, stick with long euro, in other words, short dollar. And then let's go take a peek at, there we go. Let's take a peek at, well, this week, April 24, right? That brings us up to our most current issue. So y'all get a little sneak peek here. All right, so once again, we dive in. Now, mind you, some of the things that I didn't get into, a lot of times I get asked about, Rog, what is the relationship between gold and inflation. And I explained to you all where that's coming from. So for a lot of you that are curious about why some of these things are true, how to measure recession, how to look at money flow, and how to look at inflation and gold, I do explain a lot of those things because I think that's kind of the fun part of trading, just sort of understanding how those inner workings are in there. So I throw those in there as well. But as we got into April 24, I thought, you know what? Now's the time to understand we're very likely coming up into a Fed pivot. And what then does that do? And then going into the earnings, right? We're already bullish. We were bullish at the end of March, right? Even though the regional banking crisis was happening, we were already aligning to buying XLF, buying XLV, knowing that's so bullish, the S&P and the Dow, taking advantage of Q2 sector rotation. And remembering that the Fed pivot, that's really what's going to drive a lot of the optimism for higher highs. That's what's going to get us focused on buying the dip, not buying new highs, but buying the dip. All right. So we started breaking down other markets that we have been in, things like silver, right? Gold's on a tear, but silver's been doing pretty darn well, as you can see here. Really nice uptrend in silver. And then we started getting into a little bit more an explanation of one of the neat ways to understand and measure the way in which yields, treasuries are looking at the Federal Reserve is to look at the 2-year note, right? To look at things like HYG and the long bond and notes. So when we are looking at certain symbols, a lot of times we don't know why or what we're looking at. And I dive into those things because if we don't understand why we're doing something, gang, because I said so works for mothers, right? Everything else is about, well, why, Raghee? Why would that do what you're saying it's going to do? So that I believe that education, that level of transparency is very important, is actually traveling the same path of confidence. When you understand why those connective threads are there, all of a sudden, when I say, hey, gang, real yields are dropping, you're already knowing, okay, this is what it means to gold, and I know why, right? And that's what this homework is really all about, okay? We started talking about Microsoft and Google. We know what Microsoft and Meta have done to the market, so we know that the tail wags the dog. As we got into the latter part of April, the last issue, we knew that, look, I can talk about the Federal Reserve all I want, but between now and May 3rd, the main story is going to be what's Meta going to do? What's Microsoft? What are these heavily weighted tech stocks? These are, so we aligned and really focused our attention to, here come earnings, right? And mind you, we'll worry about the Federal Reserve in another week or so. But right now, what is Microsoft doing? What is Meta doing? High concentration weighting is going to influence a lot of what we need to look at. And during earnings season, it's almost like a little bubble for a few days, for a week or so, especially around major high concentration weighted earnings releases. We need to say, look, we'll get back to the Fed in a minute. We'll get back to the banking crisis later, if that's still indeed a crisis. Right now, where is Microsoft going to take the market? Where is Meta going to take the market? Where is Google? Where is Amazon going to take the market? And that's tail wags the dog season. By the way, tomorrow we have a major economic pillar in the PCE coming out. And that means we're getting a massive piece of data, the Federal Reserve's favorite release. And you bet this weekend, I'm going to dive into what that PCE means for next week. PCE comes out tomorrow, Friday at 8:30. Yeah, there'll be some interesting day trades and volatility, but over the weekend, I'm going to break that down and say, hey, this is what the PCE said. This is how the Federal Reserve is expected to act. And this is going to determine whether I'm going to continue to expect a pivot and when, right? That's going to be the next issue. Is this affecting the dollar? Is this affecting yields? What sectors are going to benefit? And we're going to do that analysis, and that'll be the next issue of this week in the market. And this is my job, right? This is our job. But granted, I've been doing this a long time. I'm 30 years into this trading game. I fine-tuned a process where over the course of a few hours, I brain dump the things that are going to basically be what's going to have my attention and likely be the most important aspects of market movement for the coming week. So we come back, we do this every week, right? We can't do this at the beginning of the month and expect that's the only thing to worry about. Every week we come back and say, okay, this is what happened. This is what we can do about it. And these are new stories and new emerging and new data that's coming. PCE is going to be one of those new emerging important data points that will factor into likely what we're going to do going into May. It's a big number, gang. It's a really big number. So it will have a big place in this upcoming issue. All right. So any questions as we wrap up our time here together? I hope this has been helpful in terms of what I'm looking at, why I'm looking at it, the way we need to look at it, and then how that makes its way over to the charts. And we do a lot of sector rotation analysis, as you can see here. And then we get into, where it is that I'm interested in getting bullish. Like, for example, last week we said we want to get bullish things like McDonald's, Pepsi, Google, Microsoft, Meta. Those were on the bullish list, right? It doesn't mean there's automatically a buy. But again, remember, gang, homework is not about the specificity of I'm going to buy here and this is my target. Homework is about, am I looking in the places of the highest probability setups? Look how short the watch list is, gang. This isn't about having 400 names to go through. This isn't about having 100 names to go through. This is about having maybe 2 or 3 dozen names, if that many, to look at. When you go through your watch list process, ultimately you should have a lot of clarity about what you want to do next. Yes? All right. So with that being said, how many of you might think, yeah, Rag, I'd like to get my hands on your homework. That I can see what it does. I can see why the data then maps to ultimately the trade. How many folks want to get a hold of this? Now, I will tell you, the newsletter is $79 a month, right? So every month you get 4 issues from me, as well as a Friday video, okay? But for the next, I think it's just about a day. Yeah, I think it's about a day. Between now and I think midnight tomorrow, instead of, I don't know the math on 79 times 12, but I know 80 times 12 is what, 960? Okay. Instead of that per year, or instead of roughly $240 every quarter, right now what we're doing as we're rebooting this week in the market, we are offering, and you can check this out here. Let me give you the link. It'd be nice if I gave you the link, wouldn't it? All right. simplertrading.com/this week. I got a nice short link for this. If you head on over to simplertrading.com/this week, you can go ahead and pick up these deals right now where you can hang out with me for a quarter. I will tell you, gang, in 90 days, well, first of all, you're going to get 12 issues from me, but you will learn a lot about the process behind what it is I look at. It's not just seeing what I'm doing, but I do a lot of explaining because, again, part of the confidence is the transparency. So like I said, whether it's understanding what corporate yields really are saying and doing, the 2-year note, gold and inflation, that euro US dollar combination that's had us bearish dollar and bullish euro for months now. How do we understand that Q2? How do I show you the data that makes you see, oh, Rag, I see it too. And if I see it, I'll feel more comfortable to act on it, right? So basically this is $58 a month. And then the annual works out to about what, $49 a month? Don't hold me to this. I'm an English major. I think that's about right. So instead of at 79, we're doing a very, very short-term special. If you want to jump in, get information like this, get my homework. I sit right. So this is my office, by the way. Can I show you all my screens? My office is a little dirty, but take a look. I don't know if y'all can see this. All right. So this is where I'm sitting right now. This is mission control. And every weekend I'm sitting here figuring out where do I need to point myself in order to find these opportunities. All right, gang. So you can check that out over at simplertrading.com/this week. I just got a shortened link for that. I think the other link was, let's see. Yeah, there we go. simplertrading.com/this week. Now, does anyone have any questions for me? I'm happy to go cover a few questions as we wrap up. What am I looking at to get flows? Coop, I look at a few places. Mostly you can look at ETFDB. Yeah, mostly you can look at ETFDB. Thank you. Like The Office. This has been my office for many, many, many years. I was a brand new trader in this office once upon a time, 32 years ago. So yeah, it's a special place. I appreciate that. I appreciate that. So yeah, there's a number of sites that I use, and a lot of times I'm using the Federal Reserve's very own data. There's a lot of very cool data out there that helps us get this level of clarity. Yeah, for sure. Gregory says, great. I like the primer on how to use this week in the market. Yeah, I'll tell you what, Gregory, not only, I'm glad this was helpful. I'm super glad. Any reason for me to talk about markets make me happy. Every Friday, on top of getting the issue, you also get a video from me. And in that video, I'm going to walk you through a lot of things that I'm looking at. So every Friday, there's a video that accompanies the new issue. So the issue comes out on Monday, and the video comes out on Friday. So you can check the Friday video. I believe it comes out Friday. Yeah, you can check the Friday video over the weekend, and then Monday, first thing, you get the new issue. So it's a really good 1-2 punch of catching a 10, 12-minute video on Friday, enjoying your weekend, and then Monday, you get basically everything that I'm seeing condensed down into a nice, easy to digest game plan, right? What am I looking at and why? All right. I appreciate that, Kelly. I appreciate that. Thank you so much. No, I love it. Thank you so much, gang. Thank you so much. All right. So that is, that's it. Okay. Thanks, gang. Thanks for your time. I'll see you all in Charts and Coffee tomorrow. Please remember, again, this week in the market, you can check out the deal at simplertrading.com/this week. And there it is. Yeah. So this is now until the 28th. Gang, I don't make all these rules, but please, I like to tell everyone when things are on sale. A lot of if I've got an indicator on sale, or if I've got a class and I'm telling you all, this is the best deal you can get on the indicator. When things go on sale, I always like to let you know, because anything that you can save money on is capital that can be in your trading account. So please, gang, don't think about this on Monday and go, oh, I wish I would have gotten that, because it's not going to be at this deal. So you've got basically about a day. And even if it's just a quarter, I know that after even one quarter, you're going to find that A, it's valuable, and B, Rog, I get the game that's being played. I get the game on television, and I'm not going to get swooped up into the fear mongering. By the way, gang, this is the market that's supposed to roll over and die, right? I don't care what happens 12 months from now. We're getting together looking for opportunities every week, right? Isn't this the market that was supposed to circle the bowl, right? Nope. There are opportunities, and I showed you a few of them here. So I hope that you remember what I've remembered, that the best traders I know, the most profitable ones, they are ridiculously optimistic. I don't mean they're Pollyanna and sticking their head in the sand. They're looking for the opportunity, because they know, as I've shown you here, flows out of one corner of the market are going to benefit something else, right? Flows out somewhere mean flows in somewhere else. And that's our job to find. Okay, gang, have a great one. I really appreciate it. Thank you very much. No, I definitely feel like this will point you all in a great direction. Check it out, simplertrading.com/this week. I always like to let you know when a sale is happening, and that's exactly what we've got right now. All right, let's see. Make sure I'm not missing any questions. And again, Monday, there'll be a new issue. Friday, though, you get the video. So starting tomorrow, you can get the video that I share with you all in This Week in the Market. And then on Monday, you'll get the new issue. All right, be good to each other, gang. I'll talk with you soon.